Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Nowadays, there's an increasing number of investors who rely on dividend income as becoming impatient and looking for new investment options. And there's a valid reason for this. Traditional investments like the Schwab US Dividend Equity ETF or SCHD give a modest starting yield of about 3.5%. However, on the other side, there is a promising substitute in the form of the Yield Max ETFs, which give approximately 70% in distribution rates. In this video, we'll explore one of these traditional and alternative options, explaining how they work. We'll also calculate how much dividend income you can expect to receive if you invested $5,000 in each ETF. So stick around, hit that like button, and subscribe for more. Let's start with the traditional and popular among income-focused investors, the Schwab US Dividend Equity ETF, also known as SCHD. This ETF strategy is quite simple. It aims to closely mimic, before fees and expenses, the overall returns of the Dow Jones US Dividend 100 Index. To do this, the fund primarily puts its money into stocks listed in this index. This index is designed to gauge the performance of American companies that consistently pay dividends and are financially solid when compared to their peers using financial ratios. In fact, the fund will put at least 90% of its assets into stocks. We have previously discussed SCHD in detail, and you can check it out in this video right here. Overall, SCHD is a simple, cost-effective fund that can offer potential tax benefits. Whether you're building the core of your portfolio or looking to complement it, this fund can be a valuable addition. It tracks an index that prioritizes high quality and sustainable dividends, investing in stocks selected for their financial strength compared to others using key financial ratios. Now, let's take a look at how SCHD has been doing this year. Unfortunately, it's showing a decline of 1.02% so far this year when we consider only the price movement. But when we expand our view to the maximum available time frame, we find a different story. SCHD, with a price return alone, has surged by a remarkable 187.08% over its longer history, and that's without factoring in dividends. Now, let's turn our attention to one of the alternative investment options for investors seeking high dividends, TSLY, short for Yield Max Tesla Option Income Strategy ETF. This ETF offers an impressive distribution rate of around 69.26% and pays dividends on a monthly basis. It achieves this through a strategy involving covered calls. Comparing it to traditional dividend ETFs such as SCHD, it looks very impressive. But how does TSLY work? Well, in the fund's summary of Yield Max TSLA Option Income Strategy ETF, its investment objective says, the fund's primary investment objective is to seek current income. The fund's secondary investment objective is to seek exposure to the share price of the common stock of Tesla Incorporated, subject to a limit on potential investment gains. In terms of fees for this ETF, it carries a relatively high fee of 0.99%. It has a relatively high management fee of 0.99%, and there are no additional distribution fees or expenses. Then, if we look at its principal investment strategies, the fund is an actively managed exchange-traded fund that seeks current income while maintaining the opportunity for exposure to the share price of the common stock of Tesla Incorporated, subject to a limit on potential investment gains. The fund will seek to employ its investment strategy as it relates to TSLA, regardless of whether there are period-averse market, economic, or other conditions that will not seek to take temporary defensive positions during such periods. As further described below, the fund uses a synthetic covered call strategy to provide income and exposure to the share price returns of Tesla, subject to a limit on potential investment gains as a result of the nature of the option strategy it employs. The fund's options contracts provide exposure to the share price returns of Tesla, current income from the option premiums, and a limit on the fund's participation in gains, if any, of the share price returns of Tesla. It then says an investment in the fund is not an investment in Tesla. This might be the most critical aspect that's causing a lot of confusion among many people. It says, as part of the fund's synthetic cover call strategy, the fund will purchase and sell a combination of standardized exchange-traded and flexible exchanged call and put option contracts that are based on the value of the price returns of Tesla. To summarize, the fund's strategy will cap its potential gains if Tesla shares increase in value. The fund's strategy is subject to all potential losses if Tesla shares decrease in value, which may not be offset by income received by the fund. The fund does not invest directly in Tesla, and therefore, fund shareholders are not entitled to any Tesla dividends. TSLY's fund summary will help us clarify a key misunderstanding among investors who think TSLY is a way to play Tesla stock price appreciation. It is not. While TSLY's performance is based on Tesla stock, it is crucial to realize that because of the covered call strategy, TSLY will lack Tesla stock by a large margin if the stock is soaring. As the chart shows, Tesla stock is up more than 138% year to date, while TSLY is up by only 67%. This brings me to talk about who should not buy this TSLY. This ETF is not good for folks who want to ride Tesla price appreciation over time. If you believe Tesla stock has substantial upside in the long term, you should just invest in Tesla stocks or options, not TSLY. By design, TSLY will go down in value with Tesla stock when the later stock is under pressure, although TSLY's decline will be offset somewhat by its dividends from selling options premiums. On the other hand, when Tesla stock is on a tear, TSLY is not going to catch up, because its upside is limited or capped at the strike price. People should consider TSLY if they are looking for monthly dividend payouts. If we take a look at TSLY's historical dividend distribution since inception, we can see the ETF's dividend is consistent at elevated levels. This phenomenon is primarily attributed to Tesla stock's inherently higher volatility, which results in more attractive premiums for selling Tesla options. The dividend amount paid by TSLY is remarkable, considering its stock is priced at just $14 or $15. If we look at TSLY's total performance by including dividends, it's delivered an impressive 67% year to date. While it's not as eye-catching as Tesla stock itself, the result still puts TSLY ahead of most investments in the market. SCHD offers a starting dividend yield of around 3.5%, making it an appealing choice for long-term investors who prioritize stability and consistent dividend growth. While it may not have the same eye-catching returns as TSLY in the short term, it is well known for its history of delivering higher dividends over time and a meaningful price appreciation for long-term growth. In contrast, TSLY has a remarkable dividend payout ratio, which is ideal for people seeking income on a monthly basis. You see, we don't know how this ETF will perform in the long run because it is so new, but so far the numbers look really good. It has garnered significant attention from the dividend growth community. Next, I'll demonstrate how much you could potentially earn each month by investing $5,000 in SCHD compared to $5,000 in TSLY. So, let's dive into the numbers. First, let's look at SCHD. With $5,000, you'd get roughly 66 shares. SCHD pays dividends every 3 months at about $0.66 per share. So on average, a $5,000 investment in SCHD could yield about $43.50 every quarter, or about $14.5 per month in dividends. Now on to TSLY. The same $5,000 could buy over 346 shares due to its lower share price. TSLY pays monthly dividends, and the latest dividend is around $0.83 per share. If we multiply the last dividend amount by the number of shares, you could earn approximately $287 per month with TSLY. In theory, this means you could earn an extra $270 each month by choosing TSLY over SCHD. That is a significant difference in the amount of dividend received. But remember, TSLY is newer and riskier compared to SCHD, and over time, SCHD should benefit more from price appreciation. Your choice should match your risk tolerance. SCHD offers stability with quarterly dividends, while TSLY, despite its volatility, provides higher monthly dividends. The choice depends on your risk tolerance and investment goals. And now, it's your turn. If you had $5,000 to invest in TSLY or SCHD, which would you choose and why? Share your thoughts below. And if you found this video helpful, please like and subscribe for more content just like this. And that's gonna be it for me today. If you feel like you learned something new in this video, consider hitting that like button and subscribing to the channel. Your interaction helps me put more effort on trending stocks like this one. Either way, thanks for watching, and until next time, take care.